Welcome, everyone, and thanks for joining us on today's panel discussion webinar, How to Measure the ROI of Your Risk Management Program, brought to you by the IT GRC Forum. I'm Kelly Vick, the host of the program, and it's my pleasure to welcome today's speakers. Our moderator is Colin Whitaker. Colin is the founder and director of Informed Risk Decisions. He has over 30 years experience in cybersecurity, and he currently provides cybersecurity risk consultancy services to a wide range of public and private companies. Colin has presented on information security at major events around the world and has published a number of papers on security. And on the panel, welcome Aaron Pikin, Senior Solutions Engineer at OneTrust, Evan Tegethoff, Vice President of Solutions Consulting at BitSite, Faison Tai, Customer Success and Implementation Senior Manager at LogicGate, and Jared Zittel, Director of Risk for North America at Protect Group. We'll get to introductions in a moment, but first, a short housekeeping video. We'll be right back after this.
The IT GRC Forum, educational content for governance, risk management, and compliance professionals. A forum for thought leaders to address today's GRC and IT security topics.
Taking that threat intelligence and using that as an overlay in your existing systems becomes really important.
There is a big difference in service providers versus other third parties that you might be providing data to.
But it highlights organizations' lack of preparedness for situations like this.
Here are some housekeeping notes to be aware of. This webcast is interactive and we want your questions. Please submit these at any time using the Questions tab, and we'll address as many of these as possible during the webinar. We've also lined up some polls to get your input, and we'll notify you when these are active. Please be ready to submit your response when prompted by using the box below your console. Just make sure the slides are not in full screen mode, or you will not see the options. Make sure you check out our supporting resources in the Attachments tab, as we've uploaded some great content for you today. We want to hear from you, so don't forget to leave your feedback and comments. We take feedback seriously, and it helps us plan for future programs. This webinar is approved by NASBA. To qualify for CPE credit, you must demonstrate participation by attending the full session, responding to the polls, and by rating us at the end. Certificates will be issued within 7 days from our learning management system, the IT CPE Academy. So please watch out for the email notification and check your spam folder if that doesn't come through. After the live presentation, this webcast will be available on demand. So please share with any colleagues who you think will be interested in the topic. And now, let's get started.
Okay, so on today's session, we'll delve into the intricacies of measuring return on investment of your risk management program. And we'll cover how to define and align measurable objectives for your risk management program, identify relevant KPIs to assess the effectiveness of your risk management efforts, techniques for collecting and analyzing data to measure ROI accurately, and communicate ROI findings to stakeholders for enhanced decision-making. Moving on to the agenda, we'll begin with speaker introductions before running over some quick tips recommended by our panel, and then we'll dive into the Q&A discussion facilitated by Colin before closing with takeaways and further information at the end. So now, without further ado, over to you, Colin.
Thank you very much, Kelly, and good afternoon, everyone, and welcome to this panel. As Kelly mentioned, we're going to start by running around our virtual table here this afternoon. We're going to try and hear a little about our panelists, understand a little about themselves, their organizations, so it'll help everyone understand where they're coming from in this afternoon's conversation. So we're going to start with yourself, Jared. Good afternoon and welcome. Can you ask you to tell us about yourself and the work you're doing there at the Protect Group?
Jared Zittel, North American Risk Director. I've been head of risk management for 3 leading financial institutions. Been in the profession for risk management for a long while. Protect Group is a global ERM provider, and they've been in the GRC space for over 20 years. Protect redefines the way people think about risk management, helping companies to increase performance, achieve their strategic objectives, better understand, monitor, and help them manage their risk. It's all about effective risk and reward taking. Thank you.
Brilliant. Thanks very much, Jared. Let's move on to yourself, Faison. Tell us everyone about yourself and the work you're doing there at LogicGate, sir.
Hi, yes, my name is Faison Tai. I'm a senior manager in the customer success and implementation org, where I help large enterprise and strategic customers implement our platform, and also at the same time help from a portfolio and account level perspective, help manage their roadmap going into the future. Prior to LogicGate, I was at Walgreens, where I helped them build out their GRC platform all across the globe, and served as a consultant for a very long time. And LogicGate really helps you transform risks into strategic opportunities by offering a no-code platform for you to manage and assess your risks.
Brilliant. Thank you very much, Dean. We move on to Evan. Good afternoon, Evan. Tell us about yourself and the work you're doing there at BitSight, sir.
Thanks, Colin, and thanks everyone for joining. Happy to be here today. So I'm with BitSight. My role here is a vice president of solutions consulting. Essentially, I have the engineers and consultants in both our consulting engineer group and our professional services group here at BitSight. So my groups really help our customers to utilize BitSight's cyber risk management data most effectively in their use cases. And BitSight as an organization is a cyber risk management data organization. The aspects of our data that are most appropriate for what we're talking about today are really things in the realm of attack surface data for yourself and for third parties, financial quantification data around cyber risk. We also work with a lot of cyber insurers and critical national infrastructure. So happy to be here.
Brilliant. Thank you very much, Evan. And all that's going to be very relevant to this afternoon's conversation, I am absolutely sure. Finally, but definitely not least, we go on to Aaron. Good afternoon, Aaron. Tell us about yourself and the work you're doing at OneTrust.
Yeah, thank you, Colin, and thank you for having me today. Again, my name is Aaron Piken. I'm a sales engineer here at OneTrust within our GRC offering. So I support all of our largest customers by providing demonstrations, POCs, and solution design throughout the pre-sales engagements. I've been with the company just under 4 years and hold certifications across privacy, GRC, as well as third-party risk. And prior to my current role, I spent some time on our implementation team, so helping hundreds of our existing clients implement the GRC solution set across a wide variety of use cases.
Brilliant.
Yeah, and at OneTrust, we've really pioneered the category of trust software. So we provide purpose-built integrated solutions to over 12,000 customers of all sizes and verticals to help unify and operationalize efforts across privacy, ESG, GRC, ethics, as well as third-party risk. Within the GRC cloud specifically, we do this by taking an integrated approach to risk management. This set of solutions that you see on the screen here provides a unified platform with various workspaces, out-of-the-box guidance, and automation to serve these different teams across third-party risk, internal risk management, compliance initiatives, as well as third-line independent auditors. So thanks for having me, and back to you, Colin.
Brilliant. Thank you very much indeed, Aaron. This is a really good panel. We've got some really relevant speakers to talk about this very important issue. But the first thing we always like to do is really cut to the chase and come up with some what we like to call quick tips. And these are really to give the opportunity for the panelists to give some ideas, so to get your thoughts going, get our all thoughts going on this issue about how to measure the ROI of our risk management programs. Well, the sort of tips we're talking about, risk being constantly in motion. I think we all recognize that. Threats are changing rapidly over there, and therefore the risks are changing rapidly. The interesting issue of how we turn cost into turning risk into a financial impact, so we can actually measure and do some real calculations on it. Understanding where we're going to invest and what the key 3 factors might be, and trying to determine where we might invest, and then looking at tools and whether it's worth spending money in tools, and if so, what sort of tools do we need to use to do these things. And I'm going to bring each of our panelists in to tell a little bit about their particular favorite tip as we go along. And I'm going to start with yourself, Jared. Now more than ever, cyber risk is constantly changing as threats evolve. So what are the good risk activities we can hang our hats on as this cycle is gathering pace?
Great point. Like, we view risk as constantly in motion. It's the focus on activities of risk management where we see the interconnectedness of risk through its life cycle. It's identification, assessment, and measurement, the control improvements, attestations, incident management, action, and action management. They're all interrelated. So today's topic is about return on investment via risk management program, or as I like to just call it, risk versus reward. There's a cost benefit in every aspect of managing risk. where you spend your precious financial dollars on resources or controls across the first, second, and third line of defense and achieving those to the bottom line. And that's where you end up then making sure you're protecting an organization. As the head of risk, I've had experience of where you need to basically balance those demands and the needs of various stakeholders. So that could be just managing around the cost of headcount, cost benefit analysis for controls, new products, how much do you spend on cybersecurity, and where do you then benchmark your cybersecurity, and then also wider context as well, to make sure that everything you're doing is brought together for a risk management program and you're efficient in that risk management program in its entirety. So ROI encapsulates business risk decision making, and that's why we say risk is always in motion.
Brilliant. Thank you very much, Steve, for that, Jared. It's interesting to say talk about cost effective. It reminds me when I was running the risk research program in the MOD, that was all about the cost effective security was the thing that we banged on about the most. And that was 30 years ago now. So very appropriate. Thank you for that. Faizan, I think many of us are thinking that turning all risks into financial impacts is somewhat of a holy grail. So how do you go about doing it?
Yeah, of course, Colin. And I think it's something that, it's not easily done within organizations, but it's something that is achievable. At LogicGate, we realize that some of these conversations need to bubble up and be at the boardroom level to be able to show and demonstrate the value of cyber risk and GRC program. So what we ask our organizations or our customers to do is start small, start with something that's going to be simple for you to be able to properly quantify, collect data, things that is readily available to you and have easy access to. From there, you can centralize and pull up assessments, create data, pull out findings, see how you can address or mitigate some of those issues, and then build and invest on platforms to be able to store and centralize a lot of that information. From there, we help some of our customers create value from a quantification perspective by brainstorming reports and dashboards that we can pull up at the board level for us to communicate the value from that perspective. So really what's important to the board from a strategic objectives point of view, but also at the same time, what also speaks to the overall organization as a whole. And then continuing to evaluate the strategic influences around some of these quantification numbers to be able to influence your board and be able to effectively communicate the value of a cyber risk program.
And of course, boards understand costs and finance because that's what they're there to manage the final outcome. Brilliant. Thanks very much for that, Faizan. Evan, in your discussion about your 3 key factors for measuring ROI, and you mentioned it in your introduction, you include, I think everyone agree with most of them, but I think people will be a bit surprised to understand why you're putting an emphasis on attack surface. But please explain your three tips to us.
Yeah, absolutely. So the first one, builds really closely off what Faizan just said, which is, understanding the financial impacts of cybersecurity events and incidents. So that is not an easy thing to do. And the types of cybersecurity and events and incidents that have happened over the years are changing. A ransomware attack is going to be very different in terms of financial, reputational, and other impacts than something like a third-party service output. And yet, if you have an outage in your third-party service that is created by ransomware, now you have a combination of events and you have a different perspective on the financial impacts. So it's very complicated. So to call it a quick tip, I was actually thinking this is probably not quick. It's a quick tip. It's not a quick execution, I would say. And then the second bullet, why we think that, grasp on your attack surface matters. This is actually a way that we've begun to re-perceive BitSight data as well, because we've typically been thought of as a cybersecurity ratings provider, predominantly, which is still a big part of our data. But what we've actually found is that a large part of the consumers of our data are using it in order to understand their attack surface. So why I think this matters for ROI and for ultimately cybersecurity risk management is because the attack surface today includes cloud and other elements that are not what people traditionally think of as their attack surface, that now is not only just as important but for many organizations it is far more important, and it can open you up to things like shadow IT showing up because you have other areas of the organization signing up cloud service providers, and it's just a very different attack surface. So when we say attack surface, it's a much broader concept, I think. And so that's why I think it relates very closely to that, because it also, in terms of ROI, it will be different measures you might take to put controls in, depending on what area of your attack surface you're really looking at. And then lastly, consider your risk options. So I think I've been in cybersecurity now for 25 plus years. And I think some of us who've been in the industry so long that, when we think about moving into cyber risk management, cybersecurity risk management, remember, it's not all about just protecting or eliminating everything you possibly can. It's risk options. So, where are you going to spend on controls? When might you accept risks? When might you transfer it to, insurance or some other means? Because that's really, for me, that's the movement from, just when we think of hardcore, nerdy cybersecurity into really risk management.
Brilliant. Thank you very much, Steve, for that, Evan. And to follow on from your point there about looking at options, we're actually now these days looking at much more standardized controls and standardized tools in this space. And that's really going to help constrain costs. So, Aaron, from your perspective, anything we can do to contain costs by using these standardized risks, standardized tools must be a benefit. So where can this approach get our biggest bang for our buck in terms of ROI, do you think?
Yeah, what we've seen with our customers is oftentimes risk management teams are small but mighty. It's tough for them to get a good picture of the entire enterprise and their exposures, especially if you have multiple product teams, each product team developing their own software or products and services. So what we recommend is to look for solutions to incorporate that can automatically flag risks in a standardized way. That way, if somebody's bringing on a new vendor or implementing a new system or project, we can ask them a set of, frontline friendly questions, offload some of that risk identification to that frontline team, translate their responses into a set of standardized or consistent risk metrics for the central GRC team to review. And so this helps both time spent reviewing assessments, time spent assessing the business, but improve consistency with the risks that are generated so that you can really prioritize them in a central location, even if they're coming from all around the business.
And I guess in one sense, using Evan's approach of attack surface would actually contribute to that as well as one of the methods of doing that. That's brilliant. Thanks very much, Eva. It's lovely to see all these tips actually merging into one there. It's really a useful flavor for the rest of the conversation. So thank you for that. I think we've set things up really good for this afternoon's conversation. We've got the headshots up there to remind you our affiliations to provide context to our answers, which is a great. I want to remind you all, this is an interactive conversation. You, the audience, are part of this conversation. But please feel free to use the question tab liberally, as one person has already done. And I'll try and feed your questions through as we continue the conversation this afternoon. Now, as usual, I try to put together a sort of narrative for this afternoon's conversation. And really, this is all about recognizing that risk management, in many ways, is a no-brainer. Trying to work out how it can be cost-effective and generate ROI has to be part of that consideration, because none of our enterprises have got all the money they would like to spend, particularly as threats and risks are changing and new risk categories are being introduced, as we'll hear later on in the conversation this afternoon. So for this narrative, we're going to start off with talking about some of the fundamentals of risk management, so we're all on the right page. We're then going to go on and talk about how we might quantify risk and be better at doing so, and then finally look at some of the tools and processes that might help us generate a better understanding of where the ROI is being generated, so we can actually report that out to the board. So let's make a start. The definition of risk that Jared's provided me is the effect of uncertainty on objectives, which I think is quite a nice way of describing risk. But many organizations struggle with the volume of information. We've heard about some of it already, ranging from operational risk through to IT, to cyber risk, to ESG, and a whole raft of other things as well. So from your perspective, Jared, how does a risk team align to business objectives and then demonstrate value to the board?
I think that if you step back and think around strategic objectives that companies have, they're purpose statements that create an overall vision and set goals for them with measurable steps and to help them then achieve the desired outcome. So to do so, you need quantifiable or statistical results to help with observable data. So when you have a risk lens, you're taking a risk lens on those particular objectives. So you're trying to say what's measurable for them, and then we then try to include them into our dashboards at ProTech. And that's how we manage our business as well, is taking those statements, building on objectives, and then even for ourselves internally. I think when you talk about board reporting, in my own experience, this is an art and a science. You have too much information, the board loses ability to work through and challenge the information. It takes them a long time. Too little, the regulator then complains, so you've got insufficient information and you're not meeting their objectives from them from an oversight perspective. I would say maybe one anecdote for an example was, okay, when working in one organization, we had the business that's growing very well, increasing new clients, new AUM, business is being very profitable. It looked absolutely fantastic on a performance basis. However, on a risk basis, we have an ERM dashboard that then was giving us some warning signs. This particularly showing to us that the service delivery was at risk, with also operational indicators such as reconciliation, QA breaks, capacity metrics telling us that the operational team was under stress. Using that then enabled us to then say, put a pause in place, and by putting the pause in place, spoke to the board, we're outside appetite, we needed to then get back in with appetite. So we didn't want to impact the client's overall objectives of making sure that they had service delivery in place. That's where we use dashboards, and that's why it's like a balancing act of trying to deal with this. The whole board reporting information that you just spoke about was, for me, it's costly, inefficient. You've got data across multiple different risk areas and different risk types. And in a prior life, I was doing that, just pulling Excel and getting those consolidated into one place, which is very difficult. You've got risk managers then producing reports and not analysing the information. And that's what you want, is our risk managers analysing the information. I'd also say for added value is around making sure that they're forward-looking. Maybe use bow tie analysis, which goes through full root cause and effect for significant risks. And then you can do stress testing and scenario analysis on that work for that and emerging risks. I find that meaningful dashboards are the way to go forward. They're very clear, easy to understand. They give great depictions, and they can be complex when you combine them with indicators. But that then helps the board challenge management. And that's what part of the measurable value add, I would say, perhaps in some intangible aspects, Colin.
Yeah, it's trying to make it meaningful, and I think dashboards can certainly help because that's what the boards are used to dealing with. So yeah, I think that's a very positive recommendation there. Thank you for that, Jerry. If we go by your definition of risk, though, we need to be able to quantify the effects of uncertainty on reaching our objectives. Faizan, from your perspective, what's the logical starting point for trying to quantify these risks?
Excellent question, Colin. Excellent question. And I go back to what my colleague Jared said. It's kind of an art and a science. Going back to my quick tip, you start small and start with a mighty foundation. You try and identify areas where you may have data already created or is easily identifiable, whether it's assets, applications, processes, keep the lights on types of activities. Let's take the example of an organization that has never done cyber risk quantification before. A lot of the times there is no baseline for some of these organizations. And being able to find specific, to your point, Colin, assets where we can find opportunities or areas where we have insight into that we already have data around, it creates a logical starting point. From that, obviously, as we continue to mature the data, as we continue to centralize and build repositories around it, to Jared's point about building dashboards and things like that, we can really try and pinpoint a good logical starting areas as areas that we already have identified or have data or insight into. And then from there, obviously, as you continue to mature your process, as you continue to mature your quantification methods, you can start to delve deeper into strategic initiatives, transformation initiatives, risk opportunities that your organization may not know that they have ability to explore into. So really what I would say, it's the first logical starting point. is use the information that you have available to you. Use the data that you have available to you, whether it's assets, applications, keep the lights on activities, or et cetera.
I think one of the important things you stressed there was it's not just about risks being a damaging thing, it's also risks being opportunities. And there are opportunities that come out from running a cybersecurity program, a risk management program, where you can identify things which you can make things do better because of the way you change your risk portfolio. I think that's one of the important things of any risk program, which can then start to show ROI. You also touched on the important issue of assets and how we actually work out where they are, and what could harm some, in which ways they could be harmed, and how they represent risks. But of course, I think we also mentioned the issue of problem shadow IT, where that exists, and where does our data and actually all our assets lie. So Evan, from your perspective, do you think most organizations have a strong grasp on their overall assets, including what's in the organization, what be in the cloud, or what they might even what people are buying into?
In a word, no, I don't think so. So, having been about a decade plus in gathering cybersecurity data, which is what BitSight does, we have lots of interesting conversations, especially since we look at things primarily from the outside in. So we continually are talking to different organizations about not only security events, threat intelligence, and other factors like that, which of course are important for them to understand, events that might be occurring in their own environments, and security hygiene factors that might affect them. But more and more our conversations have been about the identification of their assets externally, because those assets, I think we can think of assets in a couple of different ways. Data, of course, is a key asset. And I think what we're talking about here, when you talk about cybersecurity and protection of data, that's an asset. But also other assets, domain assets, they're internet-facing IP assets, assets that are the vendors they do business with, SaaS vendors, hosting provider vendors. When an organization starts to think about assets in that lens, the answer is no, they don't have a good grasp on that, because we are way past the point where cybersecurity is a castle and moat style approach, where you can kind of define a perimeter and understand what's in, what's out, and what your assets are. So we definitely find most organizations don't know all their assets. They'll actually find things in the data we present that will surprise them, and we'll do some research and find, we do have these assets, or we do have this relationship with this particular SaaS vendor, and it's storing data that is critical to us for a compliance perspective, or just some sort of internal data objective. And then the finding of shadow IT. So we touched on that a couple of times, but just to bring that point home, what we find a lot of times is we'll work with customers from that third-party risk perspective. So we'll be kind of following the bouncing ball with them to understand those relationships. And what happens with the rise of cloud and SaaS providers and that whole sector of services is that you find more and more of the business won't be going through the traditional procurement means, and thus that expanded attack surface of these other applications that might be storing your data and how to protect them. Obviously, if you don't know about them, you can't even you can't put the proper controls in place, be they process or policy or contractual, whatever the case may be. And so a couple other points here. One other point too that I think has exacerbated this too is really COVID, and then the rise of work from home, because it's taken. I've been at BitSight for 5+ years, and we've always been very distributed oriented, but a lot of organizations aren't. They became distributed in terms of their workforce because of COVID and work from home. And that just exacerbated this, subscribing to cloud applications and the expansion of kind of cloud-based perimeter, if you will. And so my main point was just, if you don't know your assets, you don't know what you're protecting. And so how are you going to, generate any ROI if you can't properly understand what you're protecting?
And importantly, some of our audience have already agreed with you 100% that it's a major issue. We don't know enough about it. So that's very positive. I'd also like to take on board that thought you mentioned about COVID and remote working and all these other things, including, I suppose, shadow IT. These are all new risks. So I'm curious, Aaron, you mentioned issues about trying to make things more standardized, make things doable. But really, when it comes to new risks like this and new things going on, things like COVID, so what mechanisms do you think, Aaron, are used best to adequately identify where these new risks lie without consuming unnecessary resources from the business? Because with all these new risks, it could take a lot of effort to try and dig in to understand them, couldn't it?
Yeah, absolutely. And when you look at your business, you have several different items that you want to build a holistic risk profile for. So you have your assets, you have your third parties, you have different projects or processes internally. We see most customers start with some form of assessments to help identify risk. So for example, if we're using a new system or a new vendor, we want to know how critical that system's going to be to our revenue generating processes. We want to know what kind of data that system's going to be processing and where that data is going to be hosted. Those assessments can be used to automatically flag different follow-up documents that need to be gathered or controls that need to be implemented or risks that need to be further evaluated by the risk management team. Now, to your point, assessments sometimes fall short in a few areas, right? First, they are time consuming for the business. You may have to send them out every quarter, every year to keep that information fresh. And it's only limited to what your business or your respondents can provide to you. So what we see our customers moving to is more of a holistic risk management or risk identification process by incorporating automated tools in addition to assessments. So things like external risk rating providers, looking at companies like BitSight. These are scores that update in real time. These are scores that are driven off of data that necessarily the respondent cannot provide to you. Looking at things like breach notification feeds or vulnerability scanners. By incorporating some automated feeds of risk intelligence into your assessment process, you can have more of a holistic risk profile for your business to the point where you don't have to wait till the end of the year for a new assessment, and you don't have to rely on your business to keep those updates coming to your team on a consistent basis.
And automating internally would be useful as well. I mean, one of the things that we mentioned was shadow IT, and therefore looking at things like expense reports in an automated fashion to find out where people are spending their money might not be a bad thing to do as well, to try and see where those new risks are. So thanks very much for that. It's very sensible. In my area, one of the things I've always done is promote the idea of risk appetite, because it sets the boundary, but also importantly, not just appetite, risk tolerances as well. And I understand also that the FDIC are going to mandate banks from actually defining a risk appetite statement in the future. So, Jared, from your perspective, risk appetites are an essential part of risk management. You'll have used them a lot in the past, and that translates into thresholds for key risks. And to manage it well, you need their KRIs, etc., to deal with it. How do you make these KRIs meaningful in respect of the risk appetite for the board, so they can understand when they are going beyond their appetite and exceeding their tolerances, for example?
That's a great question, Colin. So the board obviously sets the appetite or the risk measures. The CRO or the head of risk ends up creating the metrics and the thresholds and the performance to those metrics, including forecasts. So it's important for the risk department as well as the business in the front line to know where they stand in their sandbox. So where can I sell a product? Where can I not sell a product? As well as working on, back to my ERM dashboard, is what's the traffic light system? Where's the red, amber, green of where I can go and not go? I always liked perhaps the expectations when looking at these around compliance expectations, ones where I've got the strength and the culture of the organisation to be in compliance with regulation, performance expectations around our ability to meet the shareholders' requirements for performance, And that ties into a lot of sort of like the board metrics and the quantification of those. We can talk about those further. I can see there's some questions in the chat on those. Then there's also operational expectations around how our ability is to meet our customers and their processes. And then finally, the operational resiliency around the ability to withstand unexpected external events impacting an organization. I think that the risk appetite itself, you can go into sort of like the capacity of an organization, how much risk can a company bear, and that's probably worth a conversation. But really, risk appetite for us is fundamental in terms of our leadership at ProTech. We think deeply about this. We always talk to our clients about it, and it's something that it always sparks good conversations around how to manage this and how to take it forward. Another anecdote, sort of like outside of appetite that you mentioned, performing a project at a company that I was working with. It was the first ETF launch for this company. They were 2 years behind project. There was tremendous pressure to launch. However, going back to my operational aspects earlier, the business wasn't ready to go. It was a no-go situation for them. However, going back to the appetite, and then saying, well, actually, this particular risk around the operational successful launch was not only local, which may have been small, but had a bigger macro implication if you were failing to launch a product successfully for clients. So in that instance, CEO and board are like, no, we won't launch. We still got to make sure that we are on time to communicate that. And that's by having those parameters set from a project and to a business unit from their risk appetite perspective helps to say, keep them safe and then to move forwards.
And the question we got from the audience was basically how we use the risk appetite value in the context of measuring the ROI. Is that just a function of the configuration of the dashboard, the way you present these information?
Configuration of the dashboard, and then also determining how much can an organisation take in total risk, and then the total cost of risk, and then actually then allocating some of that then out across risk types. And then that helps an organisation understand quantitatively how to achieve that. But I'm sure Fizan, I know, probably has some comments on this as well.
Well, I think we'll go, funnily enough, I think we might be going on to some of that discussion next, actually, because we're having our first poll of the day. And the first poll is about what risks our audience are currently quantifying. So while you do deal with that, when we start talking about quantifying risk, it does sound to me that it requires a lot of buy-in from people, but not just buy-in. Sounds like we need a lot of resources, Faizan. We need some internal investment to help us be able to quantify risks effectively. Is that true?
Of course. As with any organization and any sort of initiative that an organization is going to take on, you need to have buy-in all across the board. You know, during my time at Walgreens, one of the main focuses for my role was to help our executives get buy-in for new strategic initiatives that they wanted to take on. And in a similar fashion within the risk landscape, you kind of have to do the same thing, whether it's you're creating a new opportunity, going to market with a new service offering, very similar situation here. The key to all of this is to start early and start wide. Find areas where risks can be integrated, where you can integrate from a project perspective, from a strategic perspective, and really try and take your organization on a journey as you continue to mature your quantification process in regards to ROI of cyber risk. Some of the most powerful things that I've seen some of the executives do, and some things that I've tailored for some of them, is creating stories on how some of these new services, new offerings, new initiatives that they want to take on really impact the overall organization, the strategic objectives that an organization has. And so to really tie it all home, and one of the more powerful things in human nature as well is storytelling, when you can bring and create a journey, create a story for some of these organizations on what they can aspire to be. And really that's truly how I think you can get buy-in. Tie it to strategic objectives, tie it to the organization's overall offerings and how they want to improve as an organization. And then how do these risk impacts or impede your organization's decision-making process? So how can we show the organization that, hey, if we do quantify these risks, if we do really try and determine what the ROI is on some of the risk opportunities that we do have, it can create a powerful yet meaningful message for your organization.
That's brilliant. Five times the results are in. I suppose I'm quite encouraged that 41% of the audience are currently quantifying cyber and IT related risks. That sounds very encouraging to me. Is that your sort of take on that result? And is that what you're seeing?
Yeah, generally, when it comes to organizations that are maturing that haven't tied in their strategic initiatives or their strategic objectives or their new service offerings that they're looking to delve into, generally, and going back to my initial point, you try and quantify what you know. And obviously, as you continue to mature, you can start to tie in that a bit more. But yes, Colin, that does align well with what I've been seeing in the landscape.
It's brilliant. Thank you very much, Steve, for that. Okay, everyone, we're going on to our second poll of the day, and this is about whether your organization has considered cyber insurance or not, which I think is an important consideration, and it'll be an interesting sounding board to see what your responses are in a few moments. But insurance is all about transferring risk, as we know, or at least the financial component of that risk, which is most likely, in my experience, in the context of breach protection insurance, which is where most people are buying into it from what I've seen so far. So, Evan, from your perspective, how does an organization quantify the financial impact of a cybersecurity breach? And interesting, one of the audience have also asked the question, not just in the context of a cyber breach of your own organization, but perhaps a cyber breach within your third party or the fourth to the nth party that you are responsible for. So you might want to consider that in your response as well.
Yeah, good point. So when I was looking at the previous poll, actually looking at right now about quantifying risks, when I think about it, and especially in light of the question you just asked me, I think about it as financial quantification. So not everybody hones in on it entirely on that, but I think when ultimately you're starting to report things upward more and more to less technical audiences, higher levels of management, quantification becomes nearly synonymous with financial quantification. So I actually would wonder, because if you take that poll, you've actually got 40+% on the quantifying cyber and IT, and you've got the entire risk landscape. You got more than half saying they are quantifying. But I wonder if you said financial quantification, if it might go down a little bit. They say, oh yeah, but you can't quite get there, because the financial quantification, obviously breaches are really just one part of that, but it is an important part, at least as we've found as we've embarked into financial quantification, because BitSight has not always done financial quantification for cyber risk. It's a relatively new area of our analytics. And what we've found is an important part of that, of looking at the financial quantification, is both different impact scenarios, and a number of them are breach related scenarios. And so, how do you begin to quantify a financial impact of a particular cybersecurity breach? Well, first of all, you have to understand the breach, which this leads really well into your third and fourth party question, because even when an organization has their own breach, sometimes it can take a while to forensically get to the bottom of the breach, what was lost, and it's even harder when it's on your third or fourth party side. Now, what I think is improving on that third and fourth party side is there are platforms where you can see it, breach related platforms. I mean, BitSight is just one of many where you could identify breach reporting and things like that. Obviously, there's oversight organizations where breaches are required. And then recently there's SEC regulations that are just being rolled out that are going to require more prescriptive incident reporting coming from any SEC regulated organization, which I think will improve the overall detail that you get in terms of the breaches themselves. But still, even in all that doesn't really say how do you quantify it. So when you talk about quantifying financial impact, there's a number of different ways you can look at that. I think internally, when we have typically done things like business impact analysis, there's a concept that comes into play about outages, cost of that, financial impact of that. But beyond that, and I think other areas that people are looking more and more to now on this cost is incident response costs, cost of notification in the case of a breach, those regulatory fines and penalties, which I don't know if it's clear yet on the new SEC what the kind of penalty perspective is going to be, but certainly in other oversight in other industries, there's regulatory fines and penalties. Then, of course, there's the loss of revenue. There's reputational damage, which is very difficult to determine financially. Could be legal costs. So going back to your third party scenario and the question asked there, the interesting thing that we found when we were trying to create impact scenarios and say, what are the costs from the different perspectives, is there's not only the cost of, say, a third party outage, because a breach may cause an outage, which then could cause an outage in your service. But I was just on a really interesting webcast yesterday where the CISO of GM said, everyone's a third party to someone else. And that is absolutely true. So that, your third party liability externally too. So when we started to look at the cost, we were not only looking at third party outages, but what's your liability as a third party to others? So for instance, if someone relies on BitSight's data and then we go down, it's not available, it becomes critical. Is there legality costs to that? It's a risk of a breach that organizations need to think about. And then
one of the things. Sorry,
I have a little more. Maybe I prepared too much on this response here.
Well, one of the things I would say to you in response is a lot of the financial impacts are sometimes difficult to work out until you've actually had the breach itself. They're after the fact. That's part of the problem. And sometimes, in some cases, they can actually go down below what you had. Well, I was dealing with a client about 18 months ago. They had a breach, and in that breach, they took their whole systems out.
Yep.
And they were offline for about 2 or 3 weeks. But really, they managed to recover it quite quickly because they were going to migrate to a new system. They were going to put it all in the cloud. So what they did was they accelerated the program, put it in the cloud quicker than they would have done ordinarily, which actually was a faster way of remediating than repairing and rebuilding their old systems. So from that perspective, it's sometimes difficult. And that's where we go back to opportunities. A breach might be an opportunity to do something that you never come at, you would have delayed for longer and actually more difficult to implement in the future. So I think it's a real challenging issue trying to work out what the financial impacts are. And certainly from my experience of dealing with them when I was in Visa, for merchants to work out what the financial impact of breach is quite challenging because it can be quite extensive.
Yeah.
Go back to the issue of insurance policies, though. I'm really quite intrigued to see that we've got so many people who are actually considering insurance, who have actually got policy. 2/3 of the audience or respondents have got insurance policies, and another 20% are getting them. But it's a bit odd that 1% had an insurance policy but no longer hold one, which is a little bit of a surprise to me. Do these results reflect what you've seen out there in the marketplace, Evan?
It does. In fact, I'm a little surprised it's only 1% because we've been working quite a bit with our cyber insurer partners, from the perspective. And, there has been a lot of upheaval around that in terms of changing of premiums and some other things to where there may be organizations who don't have one because they just can't afford it or they don't think the coverage is adequate for what they're trying to pay. So we have actually seen that trend. And what I was even going to mention, I know I'm probably over my allotted time, Colin. I'll make this quick though. But the other part of the understanding the real losses that has been really new to me that I've learned in working with cyber insurance partners is to understand that in that cyber insurer data, there is a lot of interesting things to be seen. I mean, how can you understand, what a breach costs? Well, if you have cyber insurance claims data to review, you can actually identify what they're costing, and you can actually put a real reasonable cost estimate on that. And so I think that whole area evolving is going to make a big difference. But it has a lot of evolution to do. I mean, cyber insurance is literally hundreds of years behind other insurance.
It's come a long way in the last 20 years. 20 years ago, I was sitting next to someone at an event, not dissimilar to this sort of thing, but a face-to-face event. And he said he was from one of the big insurance companies in the UK, and he said he dealt with cyber insurance. I said, didn't really know many people were taking out information security and cyber security insurance. He said, no, my job is to stop people underwriting it because we don't know what the risks are.
No.
Yeah. So at least we're in this place where we've now got policies in place. That's brilliant. Thanks very much indeed for that. Evan. Brilliant. Okay, let's go on to the third poll of the day. It's all about inviting you, the audience, to rate the present maturity of your organization's ability to calculate the ROI of your risk management programs. So while you're doing that, we've heard a lot of issues about quantifying and scoring, rating risks, etc. So let's take your view on it, Aaron. How can risk scoring or risk quantification be used to further increase the ROI of a risk management program?
Yeah, so when looking at the return on investment, I think it's really around resourcing and prioritization. If you can implement a common or objective scale of risk scoring across the business, then when all risks are provided to the risk management team, they can better look at them and understand where to allocate resources. How do customers do this? It's not enough to say, what's the financial impact, high, medium, or low? We need to see customers go a step further and provide enough context to their business users so that they can provide accurate data back to the central GRC team. So when you ask somebody what, say, the financial impact of downtime of a given system would be, define it in terms of number of business days down, define it in terms of amount of revenue, potential revenue lost. And don't just stop at, if there's a breach, then what would happen? But consider if, they couldn't supply their goods and services on a consistent basis every week. There may just be a disruption or an incident on, say, the vendor side or on, a system side. So providing that kind of context can really help you bring risks into more of a standardized, repeatable register for better resourcing and prioritization.
It's interesting because a lot of people have already mentioned that, as one commentator from the audience says, quantification is not a color, number, or word. Another person is talking about it could be a range of outcomes. And I think your point there of trying to define the context to get specificity of risk is important. One of the important things that I've seen organizations do is have a risk grammar as well. And if you've got appropriate risk grammar that defines risk consistently the same way for all risks, then you're actually more likely to be able to generate outcomes and impacts which are measurable downstream. What do you think of the results from the poll then, Aaron? Do we think that our audience have been honest in their response to providing and assessing their level of maturity?
I think it's aligned with what we see in the market. I work with companies from all sizes, and even some of the largest companies in the world are still at that Excel, spreadsheet, share folders, and email stage. So, if you said that you're in the immature, emerging, transitional stage, I would say don't feel like you're necessarily left out. Excel, spreadsheets, email, it does work for some companies, but eventually you will grow out of Excel and it will become too much to manage. And that's where we see customers typically take a step out of that, say, ad hoc level of maturity of manual processes and, emailing back and forth into either, a first line friendly kind of integrated platform like OneTrust, or we also see customers sometimes move into somewhat of a middle state with several heavily customized, potentially homegrown point solutions that may not be integrated with one another. And just something to think about for the audience, if you're moving out of spreadsheets, moving out of email, be wary of moving into this heavily customized, point solution space, because eventually you're going to be spending more time and money trying to fix your GRC solution than actually working in the GRC solution and working on risks. So just consider that as you move up throughout these maturity levels. There's different approaches to technology. Some are easier to use or less kind of customizable, configurable than others.
Thanks very much indeed, Aaron. Right, everyone, we're on to our final poll of the day for everyone. This one's all about which processes in your program the highest priority for optimization. And included on the list is the issue of model development and validation. And Jared, I think this is an important consideration, but from my perspective, model risk management may not be something a lot of the audience are familiar. So perhaps you can explain what it is and how one might establish measurable objectives for how they might manage a model risk program.
Model risk management is managing the risks from financial or analytical models. It's a vital component of an ERM program. We first started out with spreadsheets and we all had to decide when they were material or not material. the Fed in 2011 started the regulatory journey on model risk management, and other regulations and other jurisdictions are now caught up with that. It surprises me that this still doesn't get enough press or media around sort of like the importance of this area when we reflect back on the LTM crisis that took place and the bailout from that organization of 4.6 billion at the time, and for not capturing extreme market events in their model, to the JP Morgan the WAL incident that took place. So that is significant in terms of the activity, in terms of like impact, but it also shows, though, there's some complexity in the models, and as we drive those models forward, that are now being used in many different organizations. And at the moment now, for IT and for IT security, the most prevalent thing must be the use of AI and machine learning tools or models being used there, which has great opportunities and benefits for society, for health, for our general wealth and well-being. But also it comes with great challenges and oversight capabilities that I think will magnify some of these risks as we look to go forward into the future. So it's having measurable objectives with regards to the model type program that's looking in these areas, critical models and their risks, the whole life cycle of model risk management, from quality, validation, usage, development, governance, and oversight around data management, to metrics being used around KPIs, error rates, model validation. Although AI obviously will be looking at sort of like learning and these machine learning capabilities, but it really then says to probably one of the critical components is around having the right resources. So people, IT, and also those that are having the right tools, either data scientists or otherwise, for what is we look out into the future will be new areas that people will be looking at. So I think overall, though, coming back is a well-defined and effective model risk management program can really impact an organization, as I said, society as well. Its ROI can come through cost savings, operational efficiencies we've all heard about, but then there's compliance, customer trust, and strategic decision-making. I've been involved where just changing AML processes, for example, making passports, producing those online, making sure that they go through identification and regulatory compliance issues to ensure that there's consumer trust, ensure that there's risk reduction, it meets the regulators' requirements and delivers cost efficiency. So there's so much opportunity, but it comes with some risks that perhaps with IT and with the business is making sure that they're secure, because that must be one of the biggest risks still from a cyber perspective is the use of, by bad actors, using these advanced tools going forwards.
That's brilliant. Thank you very much. That's very clear. And interestingly, it parallels a lot of the discussion we had on our previous webinar about AI, because I think a lot of things you described about development and validation of models also applies to AI engines that we were sort of talking about on that webinar, about the rules, etc., going into those and how we validate that they're doing and the risks associated. That's really, really very useful indeed. So the results are in, and not surprising, I suppose, is that the three key ones that people are focusing on, Gerard, is enterprise risk reporting, compliance processes, and operational risk management. That probably reflects the nature of our audience more than anything else. But is that what you tend to see amongst your own clients?
Indeed, yeah. I think the most mature, obviously, being compliance and the compliance processes, enterprise risk and operational risk, sort of like catching up. I think what it shows is we're clearly still all on a journey. To get to optimized is like the goal, but we still have to keep going. And I think that when one of the questions that was posed is certainly setting out a maturity framework. Start small when you're with your ROI, even if it's just dealing with headcount, for example, as costs in the first, second, third, and fourth line. Start to measure those as you go forwards, and you slowly then build yourself up as you get more mature, looking at more measures and activities as you build those into the program and the effectiveness of your program and reporting that out to the board.
Brilliant. Thank you very much, Gerard. I think one of the things we need to consider, and was mentioned right at the beginning, was the issue of standardized tools, standardized frameworks, etc. Then how they may help optimize our risk management programs. And I'd like to put this particularly to yourself, Faizan, about trying to understand what models or frameworks you think are most respected in this space and which will scale to our businesses. And I'd like to put it in the context of a question from the audience. There's a very good question about how those same frameworks might help manage multiple IT regulatory programs and the risks associated with them, such as SOX, PCI, blah, blah, and all the rest of these programs that you could go on and describe it infinitely. So what's your thoughts on these frameworks and how they might apply in that space?
Of course, Colin, it's a great question. I think, from my perspective and what I see with some of my customers, I think the key here is that you don't need to start from scratch. There are several frameworks or several methodologies out there that you can leverage in order to quantify and measure the ROI in regards to your risk landscape. At LogicGate, we use the FAIR methodology to how we quantify our cyber risks. And we do have applications built around it to help sort of streamline and take the customer along from a standardization standpoint. I think if I go back to your point earlier, Colin, around standard risk grammar, standard risk terminology, the key here, and I think some of the things that I see across the landscape is, there's several models that are out there that we can leverage. The key here is that choose what works best for your organization, whether that's the NIST model, whether that's the ISO model. Some of these models do have risk quantification baked into them. So feel free to leverage those and then customize and tailor your approach as you continue to mature. As your organization scales, you can use more common frameworks and pull pieces together to really develop your methodology. It's not a one size fits all, and I think that's some of the things that our customers struggle with, is they try and fit themselves into a mold that may not necessarily be applicable to their organization or valuable to their organization. So really tailor your framework based on your industry, your organization maturity, and how you want to quantify and communicate the value of your risk.
And would you therefore choose a framework that's associated to any particular regulatory framework that you are applied to your industry or industry vertical?
Yeah, of course. I mean, there's for example, with the NIST framework, I know some of the values that are driven from the NIST framework allow you to quantify for things such as SOX or PCI in that standpoint. When I was at Walgreens, we were doing high trust and HIPAA compliance, and we use the NIST framework for that as well. So it really depends on which frameworks you're looking to adhere to. But generally, some of these frameworks are universal in nature, so feel free to leverage those and try and pick and choose which ones work for the regulatory governing body that you're trying to adhere to.
And it's got to be comfortable to you with the organization is the important thing. You've got to be comfortable in the organization about what your tools you're using within it, haven't you? Yeah.
Of course, yeah. At LogicGate, we see a vast volume of industries, and to try and box them in, it's kind of impossible. But that's where we have options, we have opportunities to be able to share additional resources with them.
Brilliant. Thanks very much for that. So an important factor on any ROI calculation is managing cost spend on controls, cost spend on resources, etc. Because we don't have an unlimited budget, and anything we can do to manage the cost is going to be important. So, Evan, in your state, your view on, given that they're not unlimited funds, where would you start spending your money to best effect to get the best ROI?
Yeah, unlimited money does not exist, obviously. And so a part of the whole risk decision, I mean, this is really one of the aspects of it, is how much to spend to put controls in place to limit risk. But that is not the only aspect that a risk approach helps with, because obviously it's beyond just what assets do we have that we have to spend money on controls, but it's where are we willing to accept risk in certain areas. And so as you look at, where to determine where to spend your money, a lot of what I think I've seen working with across different industries becomes pretty industry specific. To take a couple of examples, in a business that is predominantly based upon data being its most important asset will have certain protections in place around data. But on the other end of the spectrum, let's say it's an energy provider, where their critical, protection is going to be about protecting access to the electrical grid or protecting access to power generation. It's going to be a whole different perspective on where they're going to spend their money, because their risks are all so different than the other type of business. And then one thing that I think I've seen more and more organizations look at is they take that overall spectrum, if you will, of risk and say there's going to be some aspects that we put our money toward security controls to solve. There's going to be some aspect that we are willing to accept, and there's going to be some percentage of dollars that we're going to want to transfer. And that is, I think, where a lot of people are looking at cyber insurance, is to cover that piece that's really a transfer risk.
Interesting. Thank you for that. For me, I'd be certainly spending money if I was from a cyber risk perspective, certainly on looking at the things like attack surfaces and trying to manage those and get those under control. From my perspective, anything you can do in that space is going to have a bigger bang for your buck directly with any service provider, I think, these days than anything else. But thank you. That's really useful. And I think the issue of how you factor insurance and stuff from a breach perspective is going to be important. Aaron, we touched on some of the issues to do with tools a few moments ago when we were discussing. We were talking about, you were mentioning the issue about versus tools, such as your company provide and other companies provide. You were talking about spreadsheets and the value of there. So what are the benefits of moving from a risk management process from a dedicated, from a spreadsheet basis to a dedicated solution? Are there some significant benefits you might get over time in doing so?
Yeah, I believe so. So I think it really comes down to a few things. First being out of the box guidance and automation. Know that at this point in today's day and age, you're not doing this for the first time, and neither are these software companies. So when we look at things like, how do you describe financial impact? How do you describe future likelihood versus previous likelihood? A lot of this is defined and perhaps already built in a way that you can start using or adopting for your own business. And it's not something that you need to necessarily start from scratch. In addition to that, I'll add reporting in general and end user friendliness can be tough if you're working across disjoint spreadsheets. So, the ability to assign an item to somebody and ask that user to view context and respond to you on a couple data points, right? That can be very hard, if not impossible, to do at scale in Excel. And then downstream reporting. So understanding how risk aggregates across different business units, or understanding what treatments you can implement that maps to the most amount of risk to give you the most bang for your buck for your investments. So, these kind of questions that, you're asking yourself are typically easily answered in one of these more dedicated solutions, moving past, spreadsheets, email, etc.
That's an interesting question, because interesting point you made about what benefits they add. I was just thinking about it as you were speaking. One of the things they add is actually provide that consistency, don't they? And they're not just consistency because they're providing the framework, but they also provide a vehicle for training people in dealing with some of these things. Because a lot of our risk management professionals need something like a tool framework, which actually brings them all together in the same way in the same vehicle. Is that the sort of thing you would advocate as being useful for people?
Yeah, absolutely. And some of this help, or some of these training wheels, you could call it, it's more so than just the fine details. So it's great to have some examples on what financial impact means, what reputational impact means, and other ways to score a risk. But something as simple as what's a typical set of stages that a risk goes through as soon as it's identified? Treatment, review, monitoring. What are some common categories that risks are placed into? What are some common treatment outcomes that risk ends up in, whether it's reduced or avoided or accepted or transferred? So absolutely, a lot of this comes out of the box with many of the solutions out in the market, and can really give you a head start when you're moving out of something like a spreadsheet that you've defined or built in-house into a solution where that company is likely a thought leader in the space and on the forefront of some of that content.
in part it relates to one of the questions we've got, which is asking about whether the scoring is a bottom up versus top down approach type issue. And it seems to me that what you're saying is one of these tools will be very useful for gathering things from the bottom up, working up to the top to get the dashboards that Jared's talking about. Is that a way of thinking about these things as well?
Absolutely, and we think going from a bottom up perspective is one of the best ways to get more accurate aggregates of risk at the business unit level. The problem is if you're going through something like email or Excel, you're going to find yourself having to send extra emails to provide them context on what you're looking for and what you mean by high risk versus low risk, what you mean by high likelihood versus low likelihood. So, giving your business enough context to adequately provide you those bottom level scores is very important to ensure that the downstream, say, aggregated top level scores are accurate enough for your board to work off of.
Brilliant. Thank you very much, Steve, for that, Aaron. And Aaron, we move over to you in a moment because we're going to our final takeaways of the day. Just before we do so, I'd like to thank all of my panelists. It's been a really engaging conversation. I've really enjoyed it. It's a really interesting discussion, and we've come at it from some very different viewpoints, which is really quite valuable for the audience. So, Aaron, your final takeaways for the day, sir.
Yeah, absolutely. So my takeaway that I want to mention is that trust is becoming one of the most important things with the businesses that are being worked with today. Look at the airline that you choose to fly with because you know that they'll get you to where you're going on time. Look at the phone in your pocket and how they're talking about, protecting your data that you're providing to that company. The same goes for, business to business and our customers providing products and services to their customers. Typically, this building of trust, it doesn't only live within, risk management or audit or marketing. Rather, it should be embedded throughout all teams, available to be contributed to from that front line, and embedded in the design of your products and services. So,
Brilliant.
yeah, absolutely, Colin.
Thanks very much, Aaron. Evan, over to you for your takeaway.
Yes, I would just say in this area, which is still always ever emerging, just always look for sources of data, as much data as you can possibly get your hands on to continue to refine down, what the loss side of the equation is going to look like so that you're spending appropriately relative to what you're trying to protect. And that's beyond just tools, but obviously there's data tools, ratings platforms, threat intel platforms. There's a lot of other areas. My customers are always talking about the great industry associations like ISAC and the different ISACs that are around different industries. There's law enforcement agencies like InfraGard, publicly available information. There's lots of data out there, and just work to get as much as you can into your process. And then the like I said earlier, the kind of the area that I found particularly interesting that I didn't realize there was so much in there is really kind of the cyber insurance claims side. And I've heard that too, even if there were a couple of comments in the comment here about, cyber insurance isn't what it used to be. And that may be true, but you can also engage with these organizations and they will give you feedback on that type of information. It could be really useful. So data.
Thanks very much, Steve. Thanks very much. Faizan, over to you for your takeaway, sir.
Of course, Colin. I think I go back to, get started, get buy-in very quickly, very aggressively. The quicker that you can get your organization to understand the value of some of these risks and tie financial numbers to them, the better off you're going to be, and the more buy-in you're going to get across the organization. So the quicker that you can get your CFO, your CIO, even up to your CEO, even up to your board of directors, the quicker you can get them to buy in, the easier time you're going to have being able to mature your risk landscape.
Brilliant. Thank you very much, Steve. And Jared, the final last word is from yourself, sir.
Okay. I would say that it's seamless for risk management. It's all tied together. As one of the participants mentioned, it's about outcomes. It's trying to quantify some of those outcomes. And that's what the ROI is, to start at the beginning, even if you haven't started yet, trying to get something in and then move that forward and develop your program as you go forward.
Brilliant. Thank you very much, Jared. And once again, thank you for everyone. That's a really engaging conversation this afternoon. I appreciate your candor and your wisdom. Kelly, over to you to close us out.
Okay, thank you, Colin, and thank you, panelists, for a great discussion. Once again, I know our audience appreciates the information. And listeners, for those of you who qualify for CPE credit, your certificate will be issued within 7 days from our learning management system at itcpeacademy.org. So please watch for the email notification on that and check your spam if you don't see that come through. Join us again in 2 weeks for adopting the new SEC cybersecurity disclosure rules for compliance resilience. You can reserve your seat now through the console, but before you do that, please do take a moment to leave us a rating and feedback for today's session. We value feedback and it helps us when we're planning for future events. So that's it for today. I'd like to thank our speakers for your participation, with a special thanks to our sponsors, Protect Group, LogicGate, OneTrust, and BitSite. Without them, this event would not be possible. And of course, thanks again for listening. Please stay tuned for our upcoming programs, and we'll see you next time.